Hello everyone. It's been a while, apologies for that. I want to start by wishing you all a great 2015. The blog has been a bit silent because I'm working on this really cool side project. You might hear me talking about that on the website later on. So I decided to create a little video for you guys. Over the past couple of months, I've received several questions from people, readers like yourself, and I decided to answer a couple of these in this video. So I hope you enjoy it. Let's get to the first question. It's been asked by Kyle Holden. He asks, what are the best ways to find qualitative and quantitative information about companies you are interested to invest in? Let's start with the qualitative. I would recommend going to sec.com, the Securities and Exchange Commission website. There you can find company filings. Those are reports that companies have to file to the Securities and Exchange Commission, and in those files they give you qualitative assessment of their company, and they also contain a lot of figures. However, if you want to go to the actual figures, get more information than you can actually get from the SEC filings alone, then I recommend websites like Guru Focus or Google Finance, Yahoo Finance, Morningstar.com. I mean, there are so many of those websites out there. You'll have much more financial data than you could ever need, actually. So I hope those are interesting websites to check out. Another question by D. Lam Kisun. Managing positions. How often do you review your positions, and when do you exit? Well, that's a good question. I'd say, as a value investor, if you pick great stocks, you do not have to check them every day. Okay, once every quarter the companies file their new financial figures, so that's a good time to review to see if the company is still on course. Another moment that you might be thinking, well, I have to check if my assumptions are still valid, is when the stock has seen a significant increase or decrease in price. And then the question, when to exit, I get this question a lot, and I actually have three reasons to exit. One is if the company starts to experience serious fundamental issues. So not short-term things that will blow over, but serious issues which will not be solved in the short run and can cause serious damage to the company. So that's a moment to exit. You have to get rid of those companies. Also, when a company starts trading close to its intrinsic value, so there's not much upside left, that's a moment to sell. If you hold on to it beyond the intrinsic value, you're just speculating, and you don't want that. And the third reason is if you find a better opportunity. So if you have one stock which you believe has 10% upside potential left, and you find another one with 50% upside potential, it's better to sell the first one and go and put that money in the second one. Okay, next question by Jack O'Neill and Jeeves. They ask about oil, and it's a very interesting topic at the moment. Oil prices have been plummeting. They are at, well, very low levels at the moment, and what does this mean? Well, I'm not an expert on commodities. However, I do follow the news, obviously, and it can be a very interesting opportunity now. Oil companies or companies impacted by these oil prices, they definitely deserve a critical look at this moment. They might be very interesting investments. However, this thing can go two ways, right? If the oil price goes below a certain point, certain oil fields are making a loss. So below $60, for example, a lot of oil fields are making a loss. So at some point, they will decide to close them down, which means the supply goes down, and when supply goes down, the oil price goes up again. So you could, well, go for that theory, or you could say, well, the reason that the oil price is going down is probably because the US and the Arabic countries sort of they want the oil price to be that low. To put, for example, one of the theories is to put pressure on Russia, economic pressure on Russia. Well, if that's the case, then who knows how long this price will stay this low, you know? So there are two sides, and I can't tell you which is the correct one. So be very careful, but it could be a great opportunity. Let's see, what else do we have? Okay, this is an interesting question by Lena. Let me see if I pronounce this right. Lena Katoikou. I think you're Greek. Is that correct? Maybe an article on how to invest a small amount of money, like $500, and what to expect. Well, what I get from this is that you are probably just starting out. This is the first time you start to invest. Well, start with a virtual portfolio. So go to Google Finance, there you can start a virtual portfolio, you can put stocks in there, and you can actually see how much money you would have earned and practice with that for a couple of months. And once you get confident, open a brokerage account, because that's what you need. For example, Interactive Brokers, great broker. I'm not affiliated with them whatsoever, but they always win all the prizes. They're just a great company to deal with. Yeah, so open a brokerage account, put the $500 on there, and I'd recommend to buy one single stock. Why not more? Well, because you have transaction costs. And if you purchase several stocks with just $500, the transaction costs will wipe out any penny of profit you would make. So buy one stock, and then I'd recommend to transfer automatically a certain percentage of your monthly income to your brokerage account, and then until you have another $500 and you can buy another stock. But $500 is definitely, yeah, you shouldn't invest with less than that. That's really the minimum in my opinion. Otherwise, like I said, the transaction cost would just destroy any returns you make. Okay, then let's do one more by Anda Sibindi. How can the dilution of shares affect your investments? Well, that's a very good question. You sometimes see earnings per share diluted on the balance sheet, or you know, and what does that on an income statement? But what does that mean? Well, look at it like this: some employees, probably higher up within a company, have certain stock options, and when they exercise these options, they can switch them into, or they can turn them into shares in the company. So when they exercise these options, more shares are created, which means your ownership in the company shrinks. Because if you have one share out of 10 shares, you are a 10% owner. But if in this hypothetical case, dilution starts happening because of options being exercised, for example, 10 additional shares are created. Now you have one share out of 20, which means you are no longer a 10% owner, but a 5% owner. So that's how it affects your investments. And yeah, also with earnings per share, I mean, earnings per share is earnings divided by the number of shares. And if these stock options are exercised, there are more shares. So you divide the same amount of earnings by a higher number of shares, which leads to a lower earnings per share. And earnings per share are closely related to stock prices. So lower earnings per share means lower stock prices. So that's how share dilution affects your investments. And yeah, that was it for today. I hope you learned a thing or two from it. And yeah, again, apologies for being a bit silent on the blog lately, but I will get back into it once I got everything up and running with my other project. But for now, thanks for listening, and again, I wish you a great 2015. Thanks.